Looking for a daily crypto signal strategy that actually works? This full beginner's guide breaks down step-by-step how to spot, use, and profit from crypto signals every single day. Even if you're new to trading, hit like, subscribe, and let's start turning signals into real profits. The content provided in this video is for informational and entertainment purposes only and should not be considered financial advice. Always conduct your own research and consult with a financial advisor before making investment decisions. Cryptocurrency trading has become a popular way for many to seek profits, but the market's notorious volatility often leaves beginners feeling overwhelmed and uncertain. This is where a daily crypto signal strategy can be a game changer. Instead of making blind bets or trying to decipher complicated charts on your own, daily crypto signals offer clear, actionable trade ideas that help you navigate the market with confidence. This guide will walk you through an effective daily crypto signal strategy that beginners can use to increase their chances of making consistent profits. What are daily crypto signals? Daily crypto signals are trade recommendations issued each day, specifying which cryptocurrency to buy or sell, at what price to enter, and where to set stop loss and take profit levels. These signals are created based on technical analysis, market trends, and sometimes fundamental news events. The goal is to simplify trading decisions and help you take advantage of price movements without needing to be an expert trader. Why use a daily signal strategy? Trading cryptocurrency without a clear plan is like sailing without a compass. Markets can swing wildly due to news, large trades, or investor sentiment. A daily signal strategy provides structure and discipline. It helps beginners avoid emotional decisions like panic selling or chasing pumps. By following daily signals, you're essentially tapping into the expertise of seasoned analysts or sophisticated algorithms, enabling smarter trades based on research rather than guesswork. Step 1. Choose reliable signal provider. A trustworthy signal provider should share transparent past trade results, including losses, clearly specify exact signal publishing times or intervals, provide straightforward trade directions, e.g. up and down or long and short, offer realistic performance claims, typically between 53% to 90% accuracy, explain the rationale behind signals in simple language. Avoid providers that use multiple vague targets instead of clear trade directions, set unexplained or impractical stop-loss points, offer overly technical or confusing explanations, claim unrealistic win rates above 90% without credible proof, have minimal or no online presence, contact details, or community feedback. Always validate your signal provider before long-term commitment. Step 2. Set up your trading platform. After choosing your signal provider, create a trading account on a reputable exchange like Binance, Coinbase, MEXC, or Kraken. Complete all required verifications thoroughly to smoothly deposit and withdraw funds without facing unnecessary restrictions. Spend some time familiarizing yourself with the exchange's interface and key features. If your platform supports it, set up hotkeys, especially commands like open trade and close all positions, for rapid execution. As a practical example, a typical short-term trading setup for futures trading might look like this. Wallet size: $300 to $500. Leverage: 100 to 200x order type. Cost-based. Margin: cross-margin. This setup lets you comfortably manage trade sizes ranging from $1 to $5, or even up to $10 if you're particularly confident. It also ensures you have ample margin to safely adjust or double your position if necessary. Step 3. Manage your risk. Effective risk management is essential for consistent trading success. Even the most accurate signals won't win every trade, so protecting your capital is crucial. Limit your risk. Never risk more than 2% to 5% of your total portfolio on a single trade. Use stop-loss orders carefully. Exchanges cannot manipulate the candle's body, but can manipulate candle shadows. Therefore, place your stop-loss either far away from current activity, beyond the reach of typical candle shadows, or, better yet, mark your stop-loss manually using a Priceline tool on your exchange interface and execute it yourself if the price hits that mark. Know your coin. Confirm which cryptocurrencies your provider signals. Understand the usual behavior and volatility patterns of these coins. Remember, about 95% of coins lose their value within a year. Have a clear exit strategy. Decide ahead of time what you'll do if a trade goes against you. Will you immediately close the trade and accept the loss? Or will you attempt recovery by adjusting your position? Mentally rehearse or practice this strategy in your exchange's demo environment beforehand. Step 4. Follow a daily routine. Consistency is key. Establish a clear daily routine and stick to it. 1. Check the news schedule. Start each day by reviewing scheduled news events on a site like CryptoPanic. Know if anything major today or tomorrow could impact your trades. 2. Set regular trading hours. Define specific trading windows Monday to Friday, avoiding weekends and public holidays. Align these hours with your signal provider's schedule to maximize effectiveness. 3. Manage big news days. Carefully. Trade cautiously or avoid trading entirely around major news events. However, placing small calculated trades just before these events can sometimes offer profitable opportunities if your predictions are accurate. 4. Define realistic daily targets. Set clear, achievable daily goals, such as a specific number of wins, acceptable losses, or a targeted profit level, P&L. Start modestly, then gradually raise your targets as your skill and confidence grow. Stay disciplined, trade logically, never emotionally. If you don't reach your goal one day, don't get discouraged. Tomorrow offers another opportunity. Maintaining this structured routine helps prevent impulsive trades and builds profitable habits over time. Step 5. Get familiar with your trading journal. Most exchanges offer built-in trading journals. Make sure you get comfortable using yours. Regularly track and analyze key metrics like daily profit and loss, P&L. How much did you gain or lose overall today? Trade count and hit rate. How many trades did you make, and how many were winners versus losers? Traded coins. Usually matched to your provider's signals, unless you're experimenting independently. Experiencing losses is natural. The critical part is understanding why they occurred. Did you trade against the overall trend? Did you open a long position near a price peak? Identify these patterns clearly. Review your trading journal every day. Spot your weaknesses, find ways to strengthen them, and continually improve your approach. Step 6. Educate yourself. Crypto signals simplify trading, but each set of signals usually comes with recommended trading strategies specifically designed to complement them. Take the time to thoroughly understand these strategies. Treat them as your starting point. Then identify ways to refine and personalize them, making them uniquely your own. Remember, the authors of these strategies are regular traders, just like you. Their methods may indeed work, but that doesn't mean you can't improve or adapt them further to fit your individual trading style. Keep in mind that successful trading isn't rocket science. Your signal provider does the heavy lifting by crunching data and providing trade directions. Your role is to discover the small edges that can significantly boost your performance compared to traders who blindly follow signals. For example, rather than immediately exiting trades when prompted, consider setting a positive stop loss. Or, if a trade goes against you, carefully analyze whether a recovery scenario is feasible, especially if you're aligned with the overall trend. Sometimes extending a 15-minute trade into an hour-long trade can lead to better profits. But first, validate if this recovery approach truly generates more profit than simply focusing on fresh signals. The more knowledgeable you become, the better you'll evaluate signals and avoid pitfalls. Continuous education transforms you from a mere signal follower into a confident, successful trader. Common mistakes to avoid in your daily signal strategy. Overtrading. Trying to trade every signal or multiple coins simultaneously can cause exhaustion, mistakes, and high transaction fees. Ignoring market conditions. Not all signals perform equally in every market. Recognize whether the market is trending or ranging and adjust your trades accordingly. Misusing stop losses. Ignoring recommended stop losses can be acceptable if, and only if, you have a clear strategic reason. For example, if the provider's stop loss triggers too early for your comfort level, or if they signal a stop loss but remain in the trade themselves, it's reasonable to hold your position. However, if your provider explicitly calls for an exit and you choose to continue trading, ensure you have a concrete recovery plan. If you're trading with the trend, a common effective approach involves reducing your leverage, then doubling up or doubling down to adjust your entry point. This can convert a losing trade into break-even or even profitable territory. But remember, this recovery tactic typically takes longer than 15 minutes, so use it cautiously. Chasing missed signals. Entering trades late, after the price has already moved, reduces your profitability. Good signals are time-sensitive. If you miss the entry, just wait patiently for the next signal. It's usually only a short wait, typically 10-15 minutes. Frequently switching providers. Give your signal provider sufficient time to demonstrate reliability. Before switching providers, ensure you understand exactly what's not working. Often problems stem from your trading strategy rather than the signals themselves. Talk to the provider's support team first. They might clarify issues or suggest practical improvements. Supplementing signals with your own learning. Daily signals streamline your trading, but expanding your own skills will significantly boost your results. Spend some time learning essential technical analysis concepts, including support and resistance levels, moving averages and crossovers, candlestick patterns, momentum indicators, e.g., RSI, MACD. If you're already using a reliable signal provider, you'll probably remain profitable without needing anything else. Additionally, keep a close eye on major crypto news and events. They can dramatically shift market dynamics. Having CryptoPanic open right in front of you, especially convenient if you're rocking multiple monitors, is incredibly beneficial. Remember, markets usually take 10 to 15 minutes to digest significant news, giving you ample time to evaluate the situation calmly before taking action. Using technology to your advantage. In 2025, technology plays a pivotal role in crypto trading. Choosing a signal provider backed by advanced AI technology, such as Signal CLI or similar AI-driven platforms, significantly boosts your trading performance. On the other hand, relying solely on traditional human analysts or manually run signal channels generally won't provide the speed and accuracy necessary in today's rapidly evolving crypto markets. Tracking your progress and adapting. Regularly reviewing your trading journal is crucial. Analyze your win rate, average profits, losses, and emotional responses. Identify patterns that work and mistakes to fix. Markets evolve, and your strategy should too. Don't become complacent. Keep learning and adjusting your approach based on experience. That's your complete beginner-friendly daily crypto signal strategy. Ready to start trading smarter and making consistent profits? Share your questions or wins in the comments. If this helped, don't forget to like, subscribe, and turn on notifications so you never miss another crypto guide.